Joining us now, Marty Burger, former Silverstein Properties CEO, now Infinity Global Real Estate Partners CEO. Marty, great to have you with us. You just launched your firm in this kind of environment. And, you know, we all know that office real estate is terrible. Vacancy rates across the country about 19.6%, according to Moody's in the fourth quarter. But there are certain pockets, and we were talking about this in the break, that are still pretty strong. I mean, New York City housing, the vacancy rate is 1 to 2%. Where do you see opportunities?
Again, thanks for having me here. Yes, the multifamily properties in New York City are very robust because there's a lack of supply. It's a simple supply-demand issue. And New York City continues to thrive in the business side, but those businesses need to house their employees. And people want a shorter commute these days. And to do that, they want to be closer to the core of the city. And the city is not producing the housing that the mayor and the governor desperately want to produce.
So in terms of your role in this mismatch of what people need versus what we have a lot of, and that is vacant offices, do you see a path to converting some of these properties? Is that just way too expensive? Where's the opportunity?
There are opportunities to convert properties. They're happening right now. I started one when I was at my former employer, and that's going swimmingly, but it's very difficult to do. The vacant space in the office market is not going to be solved by conversions to residential. It's a partial solve, but only a small part of it.
And then when we start thinking about all of the debt that's coming due, and there are, you know, the staggering numbers coming due in the 12 to 18 months or so, can the Fed cut enough to sort of come to the rescue of some of this debt?
That I can't answer, but it's going to be an interesting market out there when all these loans come due, and people who have good operating properties just have a poor capitalization structure, and it's going to create opportunities for folks like me who are coming in to try to help that situation.
So you're setting up now. Is a hope that in the next 12 to 18 months, when that $1 trillion is coming due in terms of debt, that's when you pounce?
That's exactly the strategy.
Are there certain markets in the country, or is it New York specific?
It's nationwide. I'm going to focus on the major cities in the United States, and New York in particular.
Where are you looking to pounce first?
New York City. I love New York City. It's strong, it's vibrant, and it's doing really well.
You drive around the city in an Uber or black car, whatever it is. Do you take a look at buildings and say, that's what I want, that's what I'm looking at, I know that's vacant, it's been sitting there for a long time, I'm going to wait till this date? I mean, how do you approach it?
No, you have to look where the financial success is going to come, and it may not be from a pretty-looking building. Right,
but it's a lot about location, correct?
Location,
transit and in your business hub, et cetera.
That's very true.
Yeah. You're also looking to be in the financing part of the business, is that correct?
Yes, I'd started a debt platform at Silverstein, and I plan to do another one in my new venture.
So how does that, who are you lending to? How does that work? What are rates like?
This could be from construction loans to the mismatch in liquidity that we're going to see when all these loans come due. And so they might be senior loans, they might be mezzanine loans, might even be preferred equity.
So when we're thinking about, for instance, private credit, in the great days of private credit, maybe there's still great days. 12% is that what you're looking to lend at?
It's going to depend. If it's a senior loan, obviously it's going to be more secure, and it'll be at a lower rate. The more risky construction loans could be in a mid-teens rate.
So not a bad return there.